Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 356 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including U.S. dollar strength and what that means for investment portfolios, the recent volatility in the market, and a shakeup in the Dow Jones Industrial Average. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So good morning, Matt.
Morning, Mark. You ready to get up and finish this quarter here? We got, a couple trading days left?
Yeah, a couple trading days left. It's kind of hard to believe that we're pretty much halfway through the year right now.
Doesn't feel like it.
I just turned a year older, so that's not fun. It wasn't a fun birthday. It's 32. It's kind of just like meh. So yeah. It's all good stuff though. Enjoying the summer. It hasn't been too hot here.
No, it's been great.
Some time with the family, so it's been good stuff. But no shortage of news headlines or current events. Usually, I feel like I was talking to a consultant that we work with a couple of weeks ago, and he was like, "Hey, when is your guys typically like your off season, right? Or when does work slow down for you guys?" And usually, or at least a couple of years ago, it seemed to be the summer months, right? When everyone was on vacation. But for whatever reason, I feel like the past 3 years, it's just the busyness has continued right through the summer, and there's no off time.
No,
right?
You're not wrong.
So hopefully other people are taking some time, but we're staying very busy here.
Yes, we are. And I had another week where I had a problem picking the topics I wanted to discuss. Those are good problems to have.
Right.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
But moving on, as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on June 24th. S&P 500 index down 2.9% for the month of June, but up 7.5% for the year. The Dow Jones Industrial Average up 1.6% for the month and up 7.9% for the year. The NASDAQ Composite Index down 5.5% for the month, but still up 9.6% for the year. Russell 2000 Small Cap Index up 2.2% for the month and up 20.5% for the year. And the Vanguard All World X United States Index Fund down 1.8% for the month, but up 12.2% for the year. 3-month Treasury rate at 3.85%, the 2-year at 4.11%, and the 10-year at 4.41%. So moving on to big headlines, current events from this week. Alphabet, or Google, is being added to the Dow Jones Industrial Average prior to the open on June 29th, and it is replacing Verizon. So, what we've seen in the past, Matt, is that, typically companies that get kicked out of the Dow tend to do pretty well after they get kicked out, but they are getting kicked out for a reason because they've been a laggard and might not represent the U.S. economy as well as it once did. And, I would think that Google, it kind of makes sense because of how popular it is and how many people use it and how important it is in today's economy. But we've seen this, time and time again that every year this stuff gets evaluated. So a couple examples from the past, back in March of 2015, Apple was added to the Dow, AT&T was kicked out. That was one that never really recovered. June of 2018, Walgreens was added. GE was kicked out.
What a horrible move in retrospect.
Yeah, very,
How
very
did the
bad.
selection committee pick that?
Yeah, GE's been on a rocket
They
ship
must
over
have been
the
a
past couple of years. But
when they made that decision.
February of 2024, Amazon was added and Walgreens was kicked out. So Walgreens was only in there for about 6 years. So this happens again on a yearly basis. It gets evaluated. But, again, I think if you look at the data, the companies that do get added to the Dow tend to underperform a little bit in the beginning, and companies that get kicked out tend to do pretty well. Not always the case, but we'll see how this one plays out.
Great points. One more. We got to remember the Dow is a price of the stock per share weighted index. I find it kind of interesting that, Verizon, sub 100 on the price, they're adding in Alphabet, which is over $300 a share. So it's more than just removing one name and adding another. They're adding another that's going to make up a disproportionately larger size of that index.
Right.
I think they're trying to be a little more relevant to the other indices. Find it interesting.
Yeah, higher the stock price, higher the weighting it has in the Dow.
Correct, sir.
Last thing is Micron Technology reported earnings after the market closed last night. Micron has kind of been the darling semiconductor name so far year to date. And after yesterday's market close for the year, Micron was up over 267%. And I think this is a really good example of why we always talk about how long-term earnings and revenue growth matter for the long-term price appreciation of these stocks, right? So Micron has had a really strong year, especially a really strong month coming into yesterday's earnings report. And the stock price has been going gangbusters. Well, they reported their Q3, which is their fiscal Q3. It's really Q2.
Yep.
Numbers yesterday, and they reported $25.11 earnings per share. The consensus was $20.28, and their Q3 revenue $41.46 billion. Consensus was $35.25 billion.
That's not just a beat. That is massive.
It's a slaughtering.
Massive.
And then they updated guidance for their fiscal Q4, which is really Q3. They see their Q4 EPS range between $30 and $32 per share. The consensus was almost $25 per share. And they see their Q4 revenue at $49 billion to $51 billion. Consensus was $42.5 billion. So again, this is just, I think, a really, really good example of why we've seen this meteoric rise in a stock's price is because it's backing it up with its earnings and revenue growth.
Well said. Now think about where we're at with the calendar. At the top of the podcast, you and I were talking about we got a couple trading days left here in Q2. We're going to get Q2 earnings season for a majority of these companies in about, tongue-in-cheek, 4 weeks, right? So when you see indications like this, that this sector is doing well, what do you think is going to happen, ladies and gentlemen, to a lot of those other stocks leading into their earnings? I think July is going to be potentially a good month because June was a consolidator. It was a breathing month for a lot of these tech names. People got their swings at bat. Did they take them? I don't know. But this is very positive if you're a tech investor.
Yeah, and just looking back at seasonality data, which I know you're going to touch on here in a little bit, but
I pulled a page out of Mark McEvely's book on that one.
Yeah, I was reading some research this morning, and I was reading a piece. I think it was by Jeff Hirsch. I didn't have it prepared for today. That talks about the seasonal strength of tech or mega cap tech in general in the first half of July. So it would make sense that a lot of those names have been consolidating or pulling back over the last month, that we might be in for a period leading into earnings seasons where those names tend to do pretty well.
Juicy.
So first thing I had for our tweets, articles, and research from this week was just a chart that I created on my own of the U.S. dollar. So Jenna will share this on our YouTube page. It'll also be in our show notes. Matt, we've talked about the dollar, throughout the years of us doing this podcast and its implications. And I would say for the past year and a half, the dollar's been pretty weak, right? relatively speaking, just kind of consolidating and not trending in one direction or another.
Yeah.
And just last week, we got the dollar breaking out of a long base to the upside, and it closed at a new one-year high last week. And I think the way people can think about this is when times are good, they're buying securities, they're buying stocks, bonds, real estate, alternatives. And when they get nervous, money tends to flow into dollars, right? That's kind of the safety flight. And the other thing is that, during a stronger dollar environment, domestic equities, U.S. equities, tend to outperform international equities. And, international stocks have had their day in the sun over the past year and a half, 2 years, with a weaker, on a relative basis, dollar, right?
Major tailwind.
So is this the time where domestic equities start to outperform international again? And that was just a short-term thing. And then the bigger question, in my opinion, is also under a stronger dollar, small cap stocks tend to do even better than large cap stocks.
And look where they're at year to date.
And it's this interesting dynamic that I think is developing because you have inflation still a problem, according to the Fed. You have rates that are higher than where they were several years ago. And typically higher interest rates disproportionately affect smaller companies, right? Because they don't have the same favorable lending terms as some of the big boys, right?
Yep.
But you still see small caps outperforming this year. So it's just an interesting dynamic, and I'm very intrigued to see where this is going to go and how it's going to play out for the rest of the year.
Love your comments. I would just add one thing. I think that the tailwind that international stocks have had with the weakening dollar over the past 18 months has provided them cover for the fact that international stocks just don't have the growth rates that American stocks have had historically. And all of a sudden, when you start comparing growth rates, apples to apples, taking the currency out of it, it's a slam dunk that you want to overweight the U.S. Personal opinion on that. Then all of a sudden, you take a headwind of a strengthening dollar. That could be a tough sled. Throwing it out there.
Right. And then that kind of leads me into my next point, which was a post on X from Randy Dunham on June 22nd. Again, Jenna will throw this up on the YouTube page. It'll be in our show notes. But he posted a chart of the U.S. dollar and its performance during Trump's first term and his second term. And again, we've talked about this several times. I think I brought this up earlier this year.
Yep.
And Randy says the recent move in the dollar looks familiar. During Trump's first term,
It's insane correlation.
the U.S. dollar reversed around this time and went on a meaningful rally. Is this a history doesn't repeat itself, but it often rhymes type of thing? So, yeah, it's been a pretty remarkable how closely the dollar performance has tracked Trump's first term and second term up until this point. And by looking at this chart, if this were to continue, we should expect a higher dollar over the next year or two.
Yes. So our traditional podcast listeners, I'm looking at this chart. Mark's not wrong. Yeah.
So again, does this mean that over the next year or two, you should be weighting smalls over large, domestic over international? Usually that's what happens, but it's not like a for sure slam dunk,
That's
right?
not.
There's been rising dollar environments where large caps have outperformed small caps and international has outperformed domestic. So it's not a slam dunk, but typically this is the type of market action we see under these types of environments.
Well said.
Last thing I had was a post on X from Brian Feraldi, who was a podcast guest several years ago. This was on June 24th. It is a graphic that Jenna will put in our YouTube video that I really like. So it's two circles. There's like an outside circle and there's an inside circle. And the inside circle, the things you can control as an investor, right? The outside circle are things that you can't control.
Keep going.
So what would you guess is inside the inside circle? The big one that jumps up to me is your savings rate. And this is something that we've pounded the table on, throughout financial planning topics of the week, because we get the question a lot. It's like, okay, I'm Mark or Matt, I'm X years away from retirement. What can I do to increase the chances that I'm able to retire on time, or I'm able to increase the way I live in retirement? And the savings rate is the biggest one. It's pretty simple, right? You save more money, you're going to have more money when you retire.
Yep.
Other things you can control: how you respond to media that you watch, how you respond to geopolitical conflicts across the world, how hard you work. These are all things that are in someone's control. But what's not in your control as an investor are tariffs, economic data, inflation, politics, analysts downgrading a stock that you hold, war, government data, fund flows, insider selling of stocks, like CEOs and board members selling their own company stocks. You can't control any of that, right? Nope. So again, my simplistic advice to people when we talk about this type of stuff is turn off the financial news media, because it's just going to make you more stressed. Okay?
Correct.
That's number one.
Correct.
It's probably not going to do you any good to check your account every single day or multiple times a day, because again, it's not going to do you any good.
Yep.
But just, stay in your lane and control things you can control. And typically, if you do that, I've seen those types of people be the most successful when it comes to being time to retire. That makes sense.
It does. I'll take it one step further. At the end of the day, you got to be realistic about your investment time horizon and how that will come about in these short-term sell-offs and these bouts of volatility. And where people really go wrong is they overreact in those shorter-term corrections because they're listening to the friend that sold out of the market, or they went on XYZ financial news station and the talking head was predicting doom and gloom. Those are the people that look back historically and say, you know what, that was a mistake. I shouldn't have done that. I ended up buying back in at higher prices. You got to take this and you got to look at your long-term investment time horizon and understand the byproduct of investing in equities is short-term volatility.
Yeah.
But a lot of people have a hard time acknowledging that.
Right.
And it's funny how you and I this week blended each other quite well. You ready for my notes here?
Sure. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So my first piece is seasonality. This will be a relatively quick one. I took a page out of your book on the seasonality front. Jenna will put up this chart for our YouTube viewers. This will definitely be in our show notes, Mark. This seasonality chart goes back 20 years, and the ending date is December 31st of 2025, okay? And what you're going to notice, and I'll verbalize this for our traditional podcast listeners, is that there is a strong seasonality going into the month of July. To put some numbers behind that, Mark, the last 20 years, the average gain in July has been positive by 2.4%. That is the best month for the past 20 years, right behind November. And the positivity rate is 80%. And I just want to throw it out there that we are entering that seasonably strength. What's your thoughts on that?
Yeah,
comment?
it's just a time, like we talked about earlier, it times up with us going into earnings season here in a couple of weeks. And again, it's no secret that typically we get a nice run up into earnings season, especially if we're coming off a consolidation like we have during the whole month of June.
Sets up nicely, in my opinion. My second thing is I wanted to take a quick trip down memory lane. I saw a post by a trader that I follow. The timestamp on this date was June 20th, Mark. And what this trader posted is the one-day change in the S&P 500 on March 16th of 2020. That was the third worst day in the history of the S&P 500. So we are talking a very small data set. And why am I bringing this up? I want to hit this home. We see a little bit of volatility in the markets the last couple of weeks. And I'm not saying in general, my temperature check is investors are worried. Here's my temperature check. They're grumpy. And I'm like, get over yourself. Okay. So look at this volatility over a single day back in March of 2020. Are you ready for some of these one-day changes? Sure. I remember going home this day.
Yeah, I do too.
Okay.
It wasn't a fun day.
I had more than one martini. I'll put it that way. Google down 10.27% in a single day. Microsoft down 11.84% in a single day. Apple 12.46% in a single day. I could keep going, but it's illustrating that there will be times where the market overreacts upside and downside to news headlines. And it's the people that can stay invested over the long term that tend to be the most successful.
Yeah, and I think, if you're curious to see what the market did shortly after this, just go pull up a chart of the S&P 500 for the whole year of 2020. And, if you were one of those people that looked at this chart and freaked out and sold everything, you'd probably be pretty upset with yourself at the end of the year.
Well, here's where we stand with technology these days. People could go back in the old Independent Advisors podcast archive, go back to 2020. And it's not just you and I saying that, hey, we had a minority view of a very quick V-shaped recovery that year. And I'm going to pat myself on the back on that one along with you, Mark. In retrospect, we were right. Are we right 100% of the time? Absolutely not. But that's one I have to admit. We nailed.
Yeah, and it doesn't mean that we were questioning our view on things. It was a very uncomfortable environment, I think, for everyone. It's not like we were super confident that everything was going to be okay that quickly.
Well
but
said.
It ended up, being true. And again, this is why it's helpful to have, years and years and years of market data so that we can, compare and contrast and see how similar things might play out. And again, the market has never not recovered to an all-time high after a significant correction, bear market, drawdown, pullback, right?
Well said. We're blending each other perfectly. Ready for my last point. I saw this post by Mike Zaccardi, Mr. McEvily, on June 20th, and it has to do about the 60-40 portfolio. So for our newer listeners and viewers, when I say the term 60-40 portfolio, explain from the lens of our chief investment officer what that means.
Yeah, so, back in the day, and I think this is changing quite a bit now, but, it was very common for people to have a portfolio allocation that was 60% stock and 40% bonds or fixed income.
Yep.
And we would classify that as a moderate conservative portfolio, right?
Yep.
So that's what we're talking about here.
So what Mike posted, I'm going to quote him, the 60-40 portfolio is safe. The longest time it has taken to recover is 13 months. Stocks, and he goes on to say 24. And this is over the past 37 years, and the underlying data source is JP Morgan. I want to take us a couple of steps further. Again, the data set is from 1988 through 2025, Mark. And I'm going to verbalize this for our traditional podcast listeners. In the average 5% sell-off for the S&P, it takes 100% stock investors on average 4 months to recover, and a 60-40 portfolio on average takes 5 months. In the average 10% correction, takes stock investors 10 months to recover, 60-40, 9 months. 15% correction, 14 months for stock investors, 13 months for the 60-40 balanced. In the important statistic, the average 20% correction. Takes stock investors 24 months, takes 60-40 balanced investors 11 months. So why is it that investors tend to like to not be 100% stock? They're trying to buffer that volatility that they see within their portfolio, and this data perfectly backs that up. Now, why has this thought of the 60-40 portfolio been challenged in the market? 2022. You had a year where stocks struggled, so did bonds because of inflation. So it's not a golden ticket that's going to get you the perfect year, and 2022 is an example of that. But people don't invest in 100% equities because most people can't stomach the ride.
Right. Yeah, it's just the simple conversation of risk and return. Not everyone's goal is to make the most amount of money as possible year in and year out from an average annual return standpoint, but it's also not to have years where their portfolio is down 40%, right?
Right.
And what's the way to do that? Not have a 100% stock portfolio, right?
Yeah, and I think the thing that stocks don't get appreciation for is of a lot of asset classes that can deliver those returns over the long term. It's the liquidity aspect, right? And it's not talked about enough. And over the past couple of decades, as various sub-asset classes of alternatives have gone through their rises and fall in popularity, the overwhelming arching theme in that asset class is a lack of liquidity. And all of a sudden, you go through some of these periods like the last decade, and you see when the time you want your money and you make that call or fill out that paperwork, you're probably not going to get it back.
Right.
And this is the downside of stocks. It's mark-to-market pricing. You know exactly every second what that portfolio is worth, and you can click the sell button. Mm-hmm. And it's not talked about enough. That is such a great attribute to have as an investor.
Yeah, it is. It is for sure. So, this is a great, a great post, and, it pays for a lot of people not to be, in that 100% stock allocation, especially if you're older, because, you're going to recover to new all-time highs faster than someone who is 100% stock.
And to close that loop, it goes back to your point about focus on what you can control.
Right. Well, that's all we had prepared for today. Anything else before we leave it there for the week?
No, this will be the last podcast here for Q2 like we talked about. You start getting into July. What is it? Second week of July, we'll start to get initial earnings for second quarter. What sectors usually report first, Mark?
Banks, which should be an interesting one with, inflation staying elevated. The 10-year has been relatively elevated, and bank stocks have done relatively well over the past couple of weeks. So again, typically leading into these earnings reports, when you have companies doing well, typically the reports are pretty good. So hopefully we can get off to a strong start this coming quarter for earnings season.
We'll give you an update in a couple of weeks.
Thanks, everyone, for listening to episode 356 of the Independent Advisors Podcast. Catch us next week for episode 357.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.